Hello and welcome back. I'm Benny Victory. In this video, we're going to discuss one of the key features of getting a reverse mortgage for the senior. And that's the aspect of not having to make a monthly mortgage payment for the rest of your life as long as you're living in the property or your spouse is living in the property. Now, the formula to determine the loan amount is a separate video that I'm going to do. For this video, I just want to focus primarily on the concept of not having to make a monthly mortgage payment. Yes, you are going to have to pay property taxes, property insurance, maintain the property. If you live in a condo or a community, continue making the homeowner association, pay property taxes. But if you really think about it, whether you have a mortgage, either a reverse mortgage or a traditional forward mortgage, or even no mortgage on your property, these obligations, the financial obligations of paying property taxes, homeowners association, property insurance, these are all things that you would have to do. So they're not mortgage related. For this video, I'm exclusively and primarily talking about the concept of not having to make a mortgage payment in retirement for the rest of your life. And why is that crucial? Well, it's crucial for a number of reasons, because when you're in retirement, you're on a fixed income. And for the majority of clients, their fixed income is coming in the way of a Social Security or a pension, if they're fortunate enough to get a pension. And usually it's both spouses that are receiving Social Security. God forbid one of them passes away, and now they still have all of the financial obligations that they used to do, but now with substantially less income. 50% of the income suddenly disappears. And the senior is left with the burden of saying, how am I going to continue making a mortgage payment for the rest of their lives? So the benefit of the reverse mortgage is that it eliminates the necessity of having to make a mortgage payment. And when I discuss this topic with the senior or the children or their advisors, they become very dubious and skeptical and think, how is it possible that we could stay in this house for the rest of our lives and not make a mortgage payment? And one of the things that I love with working with seniors is that at this point in their life, they have had their home, they've had multiple of mortgages, they've had familiarity with banking and with mortgages. So what I'm going to explain is going to make sense. Maybe for the first time, the numbers are going to be more clear than ever before. But as I play this out for you and demonstrate it, you're going to very easily understand what I'm talking about. For illustration purposes, it's a little bit difficult to see, I know, but it's the best that I can do under the circumstances. What you'll see is there is two axes. This first axis is the starting loan amount that we're going to put in. This axis represents the number of years. So typically when you get a mortgage, and I've done the numbers for a very basic loan amount of $300,000 at an interest rate of 3.75, which is not exorbitant and it's not rock bottom. And again, if you've had a mortgage for a substantial period of time, this 3.75 over a 30-year period would not have been outrageous and would not have been super low. But for purposes of demonstration, I want you to be able to get the bigger concept, which is what we're talking about today, which is how is it that I can stay in this house and not make a mortgage payment? So we start off with a loan amount of $300,000 at a rate of 3.75. That produces a monthly payment of $1,389. Now, what you're familiar with a traditional, what we call a forward mortgage, is that you start off with a 30-year loan or a 15-year loan, and you're expected to pay it forward for the next 30 years. So the trajectory of a 30-year loan is you started off with a $300,000 loan amount, and then you're calculating it this way. It's arching forward towards what? The 30-year line. And maybe I could use a darker color so that it's easier to see. All right. This is a working production, so forgive me. So Here we have the $300,000. That's the starting loan amount. And what we're doing is we're projecting forward for 30 years. In the 20 years that I've done mortgages, whether the traditional mortgage or a reverse mortgage, I've yet to see a single client hold on to their mortgage for more than 3 to 5 years or to stay in the house longer than that. Typically what happens, they upsize, they downsize. But really what the most frequent thing that happens is that at some point during the span of this period that we're talking about, what happens? The interest rates come down and the property values go up. So on this side, what I have is that the first time that the person refinanced their house, the property value was $500,000 and they got a $300,000 loan. Now, based on that first number that we're working with, which is a $500,000 appraisal, a $300,000 loan amount, a 30-year mortgage at a rate of 3.75, the principal and interest payment is calculated at $1,389.35. And you're welcome to double check my math. You get an amortization calculator and you work out the numbers. Now, if you were to look inside this payment and say, what does this $1,389.35 comprise of, you'd be shocked and actually disappointed. $937.50 is interest, $451.85 is principal. So off this entire payment, you only get a reduction of your principal by $451.85. So you continue making the payments. This is time. It's moving forward. You're making payments, and these are years. So years are going by, and now it's 5 years. And 5 years, property values have gone up, interest rates have gone down. Now again, had you kept this mortgage for the entire 30 years, to give away the ending, you would have paid on a $300,000 loan amount, the total interest that you would have paid would have been $200,000. $200,164.84 to be exact. But because people don't keep their mortgage for the entire 30 years, they don't realize what is happening, which is their mortgage is so interest laden. But what happens is 5 years down the road, right? Here's the 5-year mark. What happens? Interest rates have gone down, and your property, which used to be $500,000, well, now it's $700,000. So what do? What does everybody do? You refinance. So now you get a new loan. And that starts the clock all over again. So when you get a new loan and you get another 30-year loan, that now pushes out to another 30 year. So you start the clock back and you start again. And then the cycle starts again. Maybe your interest rate is now 3.5. Okay. But because your property value is worth $700,000, your new loan amount, instead of $300,000, maybe you get $400,000. And you use that extra $100,000 to consolidate your credit cards, buy a new car, pay off your car loan. That's always the situation that I've seen in the last 20 years. But it doesn't stop there. What happens again? You go forward in time, another 5 years, another 7 years. Guess what? Property that used to be $700,000 is now $900,000. And the cycle starts over again. Okay. This is what the cycle is that you've been used to if you've had your period of ownership of your home for about 15, 20 years. Multiple times of repeating this cycle. Now, what happens when we get a reverse mortgage, and why is it that you don't have to make a monthly payment? You could, but I rarely recommend it, because the whole idea of getting a reverse mortgage is the concept that you're preserving your cash flow and you're using the equity in the home, which is the property appreciation. And before you say, well, the properties don't always appreciate, and what if the property plummets? We've got you covered, and that's the concept of having the mortgage insurance premium protection, which protects against that exact scenario of a depreciating market. But for the purposes of talking about why is it that you don't have to make a payment, this is what we're talking about. You're used to this arch of time period, and you're paying the property down, you're paying the loan amount down. What happens with a reverse mortgage is at some point, I'll erase this so that it's easier to see. Okay. At some point, your loan amount has come down and your property has appreciated. Simply, it's typically because of property appreciation more than because you've paid down the loan amount. And I have another video exactly on this point which discusses property appreciation, which is not the same as paying down the mortgage. And that would be a really good video to watch. But what happens with a reverse mortgage is this. Instead of you're going this way, instead you're going this way. Let me use the black one so it's easier to see. Your starting balance is substantially further down than where you start. And your home value is significantly higher. So you have a lot of property appreciation. So what's happening is your loan amount is slowly going up. You're still paying interest, but you're not paying it out of pocket anymore, but it's the same exact thing. In the forward mortgage, your interest is calculated as part of the payment that you're paying forward. In the reverse mortgage, it's added to the end, which is why you don't have to pay it. Now, what is the bank counting on? The bank is counting on the fact that property values continue to go up, but regardless of the property values going up, the bank has the insurance in place. So in the event that the property values go down significantly, the insurance kicks in and protects the client so that they don't have to be obligated to pay that negative balance, protects their estate so that their estate doesn't have to pay that negative balance, protects the lender so that the lender doesn't lose its money, and everybody wins. Okay, and the reason they're able to do that is because if you think about it conceptually, well, you have a person who gets a reverse mortgage at age 70, okay, and let's say their starting balance is $300,000, but their property value is at 1.2. When we appraise the property and the property value comes back at 1.2, the current balance is only $300,000 and the client is age 70. What happens? The bank says, you know what, based on the formula that we're looking at, we can count on this person getting conservatively $550,000. So what happens is that this new loan amount of $550,000, well, $300,000 of it goes and pays off their existing balance. The rest of it becomes a line of credit that's available for the client. But what are we doing? We're starting off age 70 and we're slowly increasing over time this balance. Now the question becomes, God willing, the client has a long life and they live a long life. But let's say when they get to here, the client is aged 80 and they either move out of the house because they can't sustain themselves anymore, or they want to sell the house and they want to downsize and they want to be able to be in a smaller place, or God forbid they pass away. So this $300,000 in the course of 10 years when they haven't made a monthly mortgage payment, let's say, worst case scenario, the loan amount becomes $500,000. And they've never used the balance of the line of credit, which is a whole different other conversation. But for this purposes, what we're talking about is $500,000 10 years from now, the property Whether it went up or whether it went down is two different examples. I'll give you both examples. So $500,000 now, the person is at age 80 and owes. So let's say the property is still worth $1.2 million. What do? The client sells the house for $500,000. The property was worth $1.2 million. There's $700,000 of equity between how much they owe and how much the property is worth. That equity belongs to the client. It's their money and they sell it just like a normal transaction would. Let's say the other scenario is property values have plummeted, okay? And now this property is worth $400,000. I mean, this is a ridiculous example, but I just want to make the point, okay? And even to make it better, what we do is we say instead of this becoming $500,000, the loan grew to $700,000 because let's say they did use the balance of the line of credit. Okay, in this case, let's say they used the line of credit and the property plummeted down to $400,000. So what happens? Now there's a negative equity of $300,000. In this case, the person could stay in the house for the rest of their life and not make a mortgage payment, which is fantastic. But let's say they pass away or they move to a retirement home and they have to sell the house, okay, in order to not have the tax obligation and stuff like that. Well, there's a negative equity here. There's an imbalance. They're upside down. Because of that existing mortgage insurance, the client, their estate are perfectly fine. The lender is not going to come after them and say, hey, we're short upside down and give us this money. This aspect of the mortgage insurance and this protection that it offers is substantial. And the reason it's substantial is because of the fact that if you have a traditional mortgage, like a lot of clients do, and if you think back about 2008 to 2014, where houses were underwater and there was a substantial amount of negative equity, and people were simply walking away from their home and turning the keys to the lender because they were upside down. In those situations where they were upside down, the lender didn't simply forget and forgive. The lender had the legal opportunity to pursue the client and say, listen, you're upside down, we understand, but you're obligated on this contract and we're going to come after you to get this negative equity from you. And because there was no mortgage insurance in place, the client was legally obligated. Their estate would have been legally obligated. Just because you pass away doesn't mean your legal obligations end. If there's money in your estate, the lender or the bank could come after the estate. But I give you a lot to digest, but I wanted you to kind of see the big picture of why it is that you don't have to make a monthly mortgage payment. When you have the traditional mortgage and it's a 30-year period, the interest is already built in. Just on a $300,000 loan, if you kept the loan for the 30 years, you would have paid another $200,000 of interest on top of the $300,000. But because interest rates came down, property values went up, you kept on this cycle of repeating refinancing, getting cash out, refinancing, getting cash out. Now you've reached a point where your balance is lower and you have a substantial amount of equity, but your equity is because of property appreciation. Now, the question becomes, if this property appreciation goes up, it can just as easily come down. And if it comes down significantly and you lose this property appreciation during your retirement and you're 70 years old, 75 years old, you're 80 years old, and you're on a fixed income, do you want to take the risk of waiting for this property values to come up again? You're running up against time, you're running against whether the property values are going to appreciate significantly enough. Quite honestly, you're running against running out of money because you're on a fixed income and a fixed amount of reserves. Ask yourself how much of your monthly income is being spent to cover just your mortgage payment. I'm not talking about your homeowners, your taxes, your insurance, your electricity. I'm talking about significant amount of your monthly income that is fixed, and your savings and your retirement, just to cover your principal and interest payment. And if, God forbid, your spouse passes away and you lose their income, how are you going to be able to make a monthly payment? Okay, so to finish it off, I just want you to think about this point, which is, I think, to me, the biggest aha moment that I try to share with clients. And if you get this, I think it's your aha moment, like it is for me. Let's say you owe $200,000 on your mortgage right now. You owe $200,000 and your property value is $1.2 million. Okay. But guess what? You only have $80,000 in your bank account, and you're 70 years old. You're 70 years old, your property is worth $1.2 million, you have $80,000 liquid, and you owe $200,000. If you just look at the fact that with how much money you have in your bank account and how much is your balance owed on your existing mortgage, even if you wrote a check tomorrow to the bank and paid this $80,000 towards your mortgage, you still haven't paid off your property to be free and clear. You will still have $120,000 with a mortgage, which will still continue making you obligated to pay monthly payment. So the question to the client becomes, if you're 70 years old and you have $80,000, and I'm not even talking about all the other expenses that you have, why would you want to continue making monthly payments on a house that you could stay at for the rest of your life till you're 100 years old, 110 years old, and you have so much equity, and continue making payments? The problem becomes people have become so used to chasing this, I'm going to pay off my mortgage and I got to get to the finish line, that they never consider that there's another option. And it feels odd for them. The change that you're asking them to make and to consider becomes so uncomfortable for them, because they can't conceptually understand that with all this equity that I have, there's no more obligation for me to make a monthly payment. And that's what we try to have the conversation about. That's what the collaborative discussion is with the client, and sitting down and doing the discovery to figure out what their problems are, what their concerns are, what their financial issues are. And we look at the big picture. Because if you think about it, that if I say to you, you could live in this house for the rest of your life, and you can keep your $80,000, and you have this substantial amount of equity, then paying this $200,000 down is going to be irrelevant. Because guess what? Even if you don't make this payment and this property payment, this balance goes up, you still have so much equity. You still have so many years that you can't even make up for the negative equity. Okay. And I'm going to do another video exclusively on this topic, but I just want to give you a little taste of it. Assuming you pay off your property, and now you don't have a mortgage, okay? You have a $1.2 million house. Here's your house. And you're 70 years plus. This house is not liquid. It's a giant illiquid asset. What does that mean? That means that if you suddenly need $100,000, $200,000, and you're on a fixed income, you're only getting Social Security, you have other expenses. When you go to the bank and you say, I want to get a line of credit, or I want to get a mortgage, give me some money, and I've done this for 20 years, the bank doesn't look at how much the property is worth. The bank looks at what your credit is and what your monthly income is, and what your ability to pay the mortgage back is. So if you're going to borrow $150,000, they're going to automatically assume that $150,000 is going to have a payment associated with it of, let's say, $2,000. And if your monthly income is only $2,000, how are you going to be able to pay their monthly mortgage payment? Now you say, well, Benny, there's a substantial amount of equity and the bank could come and foreclose on the house. The bank is not interested in foreclosing on the house. The bank is interested in getting its money with monthly payments and getting its interest, which it's able to do when it does a reverse mortgage, because it knows in two ways it's protected. One, through the substantial amount of home appreciation and equity that you have, and even in a declining market, it's still protected with the mortgage insurance that it has. So the bank is covered. There's no concern. When you get a traditional mortgage, a forward mortgage, the bank is not interested in coming and foreclosing on the house. If it has to, it will. But in order to not do it, it will just simply choose to not do the loan rather than foreclose and get the person out. So we covered a lot of ground, but the fundamental basis of why on a reverse mortgage you're not obligated to pay a monthly payment is because of the fact that there's substantial amount of equity, home appreciation, the balance is significantly lower, there is mortgage insurance. And all of these things allow the bank the protection that it needs. I hope I was able to make this clear as possible. This is the starting point. This is kind of like an opportunity to get familiar with these concepts. And then when we sit down in person and we look at your exact situation and your numbers, I'll do this again as it relates to your specific scenario and what the numbers look like for you, so that you have it as it relates directly to you and it'll be tailored to you. But for the purposes of just having this conversation, it's a good opportunity to be able to see everything in a bigger view. All right, I appreciate your time. Thank you very much for being my client. God bless you and look forward to assisting you. Bye-bye.